Yeah.
I gotta figure out how to.
All right. Now we're live. What's up, everybody? How's it going? Let's see.
Okay.
Yeah, so
Yeah, I just
now we're
want to make sure.
live on YouTube and X.
Perfect. Yeah, there we go. Yeah, I just wanted to make sure that I didn't have it that it was mimicking both of us. Cool.
Yeah.
Perfect. Yeah, I mean, obviously, very eventful week. Very eventful weekend with all the news that's coming out. So it is interesting that I can't think of the website name right now. I saw the Wall Street one or whatever it is that shows the weekend NASDAQ move and SPX move. It showed we were down 300 on NASDAQ as of last night. I don't know what it is today.
Yeah.
So very possible that we could be gapping down to start the week tomorrow.
Yes.
And especially with what happened over the weekend or what happened last night, I should say. It's very possible. So we'll see. Navigate the markets on basically what is given to us. How the reaction to news is, and basically go from there.
Yeah. I mean, I'm sure you saw that rising wedge that we had in the markets on the QQQ, and I've been calling that out for a little bit now. It does look like we're finally going to get that catalyst to pull back. But this market's been super resilient. I don't think it'll be resilient enough this time, but we definitely will just have to see what happens. It's been a wild last week. Obviously, some crazy stuff's going on right now.
Yeah.
Not going to speak too much on Iran and Israel and the U.S. getting involved in that.
Mhm.
I'm no expert in that
Me
field.
either.
So everybody wants to talk about that right now, obviously, but at the end of the day, we'll let the experts talk about that, and we'll just talk about having a good solid game plan
Yeah.
going forward into this week. And I am fully ready for a pullback. I know everybody's been looking for a pullback in Oscar,
Mhm.
and we may finally get one now due
Yeah.
to the Iran stuff. I think it's really going to depend on what their reaction is, what they do. If they shut off the Strait of Hormuz, then I mean all bets are off on what's really going to happen on Monday. But yeah, I did see that over the weekend markets are down, I think 1% or so
Mhm.
across the board. If I share my screen here, let's see. There we go. So if I share my screen here, just go to the QQQ. Just talking about markets real quick, guys, and then we'll get into Oscar and the due diligence and what me and Knots here are thinking about. Um, so basically, how I'm seeing it is we have a rising wedge. Been calling this one out for a little bit now. We had our break down. We have our retest on Monday, and then we've kind of just been slowly curling down. If you look at the last, 2 weeks of volume, just a ton of more selling volume than buying volume, and we've kind of just been stagnated here up towards the top of all-time highs, kind of running into that and just kind of stagnating there. The measured move of this rising wedge is actually the same as the gap fill back down to the May 9th gap down to 491.54. And if you don't know what a measured move is, it's basically taking the bottom of the charting pattern to the top of the charting pattern and overlaying it to the oh, sorry, I forgot to add it to the stage. So yeah, basically rising wedge, measured moves down here to this gap fill. So this gap fill down here essentially is down to 491.54. If we were going to get some sort of continued drawdown due to all the stuff going on with Iran, Israel, and the United States, then I see it down to 491.54. gap fill, really. Not tomorrow or anything, but over a couple weeks or something, I could see it getting down to there. What's your thoughts, Knots, on the market?
Yeah. So let me look it up on my end here. Obviously, Q's is in an interesting spot. We have the 21 EMA sitting at 523.40, just about on Q's. We have volume put in control recently, right around 517.50. So there is possible supports right below, $3 and just about $9. But from there, I mean, there's a lot of news coming out. We technically do have a lower high as of right now. Sorry. Yes. A lower high as of right now on the daily from February. So is it possible that we could go down? Yes, 100%. Does it happen? Who knows? We got to see, one, news, two, the reaction, and what's going to come out, from all the fallout. And then obviously, are people going to be buying? Are people going to be selling? And it's anyone's. You can say anything you want. We just got to kind of see where the price action kind of brings us. But as of right now, again, lower high, possibility for downside, possibility that we're going to be gapping down already 1%. So, just got to see how the market is going to take us going in the next, few days.
Yeah, we just got to be reactive, honestly, and not try to predict the markets. I know that was something that you were talking about back during the tariff crash of the big tariff crash that we had. You were talking a lot about that, not trying to predict markets, just trying to kind of flow with them. And I fully agree with that. I had to really change up a lot of my stuff with swing trading and long-term trading because it just wasn't working too much during all that volatility. When volatility spikes like it did, it's very difficult to really be trading those swings, just because you're going to get back and forth choppiness and massive moves for you, then against you. So yeah, had to switch to day trading and then just kind of bought the dip along the way. Now moving on to Oscar, guys, that kind of ties in to the whole thing with Oscar and the crash that we had with tariffs. When I first posted about it in February, I kind of went, not all in, but I jumped in just because it was so undervalued. And I just sat there and I said, I just got to get in this name right here, right now, because we just have a massive undervaluation going on here. Threw in 100K into the name, about $15 and some change, right? And then soon after that, we had the April tariff stuff, and then that just completely plummeted the market. And Oscar got down to a low of $11.20. Now I just continued to dollar cost average on the way down, and it paid off, right? It's whenever you have that conviction, whenever you do that due diligence, whenever you really understand the company and understand the valuation and how fundamentally undervalued it was, I was prepared for a bear market and continue to buy that name. It's very similar to Palantir and HIMS during the 2022 bear market. Those just kept on going lower and lower after hitting highs of like $20 and $30 and getting down to like $5. So just crazy meltdown, and just one of those things that you got to do your due diligence. You got to understand the company, and then once you have that and you see it as a 3 to 5 year horizon, you can really continuously buy the dip. What's your thoughts? Where'd you buy at?
Yeah, so one account I have 12-ish. Other account is low 13s. Overall, yes, market has run up. Well, I should say Oscar has run up a lot over the past week. Just over the last week, Oscar has gone up from 1380, near the bottom, to about 2280 at the top. $9 right there. With 3 gap up days, actually 4 gap up days, I should say. And yesterday, or I should say Friday, being the largest gap above them all, as well as a spinning top, possibility for downside reversal. We came really close to hitting my 2302 resistance. It was pretty much good enough to do it. And I think possibility that we come back into 1924 to 1979 on the chart, and possibility for a little dip buy there. I mean, I still want to buy a little bit more. I'm perfectly fine, where my averages are at 12 and 13. That, hey, we drop 8-10% here. Listen, I think I'm perfectly fine with that to get a extra shares at that 1924 to 1979 where I see us possibly pulling back to. If we go a little bit deeper into 18, I think that's another spot. That was our previous kind of like high area in May, as well as just about in January and just about in November, in December of, this past year. So 18, 1924, and 1979 is kind of where I'm looking forward to possibly buy a little extra. This past Friday, I was looking to do some covered calls for next week. Premiums weren't really that good. I should have looked a month out. I didn't do it. I don't know why. But I was looking for a possible short, going into Monday or going into this coming week to buy, a little bit longer.
Yeah. So, I mean, we're talking about pullback resistance. I think me and you both made posts about it, but, I made the little gif of the buy button. Should I buy now or should I wait to buy? And yeah, it's such a tough decision once it gets running, but in the grand scheme of things, we need to realize that this name is still massively undervalued. We'll get into the valuation in a little bit. We'll get into my Excel spreadsheet, my high five snapshot. We'll talk a little bit more about that and get into some brass tacks of things. But yeah, it's really difficult when you're not in the beginning of the move and you don't realize it until it is up here, 20 plus. But in the grand scheme of things, it's when you guys all ask us, hey, should we be buying up here? If I always say, if you're like thinking 2 to 5 years out, then it's still a great buy here because I see it going to, 30, 50, $100 over the longer term, right? But, at the same time, I understand that, if you're like, hey, should we buy here? And you're buying here at 22, and then we have this, obviously economic big geopolitical event happen over the weekend, and now we have a real possibility of coming down to fill at least the $19.24 gap. Then yeah, that would suck if you were buying Friday at 22 and then now you're already down like $2, $3. That's really difficult to see. And that's why I was saying, if you're gonna buy, maybe just nibble in a little bit here and then wait for a pullback, have that patience. And I'll be honest, the market could be down 1% and this name still has so much hype around it. It could, start going green again. Like I can realistically see that. And this is health insurance. And, just because there's war doesn't mean that the health insurance is going to go away. They're strictly in the United States. They're not even in all the states yet. They're only in a handful of states. So it's not like it's going to massively affect them. You know what I mean? But just sentiment across the board most likely brings a lot of these names down because of, the market going down and people saying, I got to get out of all this before it crashes. But yeah, the dip buy box I have is 1733. That's like if you're lucky, up to 1904. Again, it's just going to really depend on where the QQQ goes. If it does pull back 6 to 7%, then I could definitely see it come down and get down into the 17s again. If we only pull down like 1 to 2 or 3% in the QQQs, then I definitely probably only see it pulling back maybe to fill this 1924 gap before we go higher. Yeah, it just really depends on what you're looking to do. Are you looking to trade this name or are you looking to be an investor in this name over the next 2, 3, 5, 10 years? But yeah, you do have this overhead resistance from about $23 to $24 up here. I did sell some covered calls up here at $24 and $25 a month out. I locked in a lot of premium on those. And the thing about covered calls or cash secured puts, guys, You only want to be doing those if you are comfortable actually relinquishing those shares at that current strike price. So many people out there do covered calls for the premiums only. And
Yeah.
then whenever the stock keeps running and it goes above their price and then they're underwater on those covered calls, right? You're not going to lose money. You already made your premium. It's just that you'll lose if you try to buy those back, right? Once the stock runs. And typically you see that you see that really happen whenever people are selling covered calls only for the premium, but they're not actually willing and wanting to sell those shares at say 24.25.
Ronnie,
Yeah.
apparently no one could hear us
On what?
on everything.
On everything?
Yeah, I'm getting DMs and we have a lot of comments of it.
Okay. Working good on YouTube, but not on.
X, yeah. Sorry,
Yeah.
X, I should have said, not everything, but yeah.
Can they hear us now? X Spaces wasn't working.
Yeah, I'm getting a ton of messages.
Let's see. Wonder if I can.
Let me try something. Let me do this. This might work. Give me a second. Actually, I mean, they'd be able to hear it on my end. Hold on. But still.
I just streamed it to X now as well. So I'll just end the spaces and then people can just join in on.
Okay, we'll see if that works.
Yeah.
Damn, that stinks. Oh, someone said even on YouTube, on the YouTube, there's no sound. What? There's no way. I've never had these issues before. Yeah, good thing I looked at my phone. That would have sucked. Huh. So interesting.
Let's see. I'll make a post. Well,
Hold on. I'm asking this guy. Can you hear me now? Let's see.
make this post real quick.
Can't hear me? Hello? Hello? Hello, hello, hello? The mic's working.
There we
The
go.
mic is
All right, I
working.
posted about it. So people just have to migrate over from the spaces. We got 101 viewers in here, so it's working good now.
Okay.
I can hear you on X, Amy said. I can hear you fine on YouTube. All right, I think we're good to go. Let me just
Okay.
check this. Check. All right, cool. I think we're good with the live stream over here. All right, cool. So sorry about that, guys. Can we restart? Yeah. Yeah, let's just restart from the beginning, I guess. Or just let's just talk about Oscar. Markets are gonna do what they're gonna do. Really don't
Yeah.
know. Oscar. So starting from the beginning, kinda. So basically, we got our bull cases here. We're gonna talk about the fundamental analysis. We're gonna get into the high five snapshot here in a minute, and we're gonna actually talk about, some of the SWOT analysis that I've done. Bull's gonna Nick's gonna talk about some of his bull thesis, some of his risks as well, and just right now, let's just talk about the levels. So we don't know what's going to happen tomorrow with all this Iran and U.S. news. All we know is that we are at a point in Oscar where we had a massive run up. We had 3 gap ups in a row. We went from, lows of $11 to $12. Then we ran up on earnings, came back down here to about the $14 to $16 range. And then from there, mainly sparked by the Medicaid bill. So they basically, came out and reformed the the Medicaid portion of the big, what is he calling it? Big beautiful bill or something
Yeah,
like.
something like that. Yeah.
Yeah. So he came out and he basically, I think Congress, they kind of tweak things around a little bit in there to kind of protect some of those ACA, um, nuances. And basically that's going to, that's what really sparked this whole spike up. And then we
Mhm.
just got massive hype around the name, and then everybody started looking into the name, and then everybody was like, "Oh wow, this thing really is that undervalued on a PEG ratio, on a PE ratio, on a free cash flow yield ratio, on a EPS ratio, on a discounted cash flow ratio." I mean, every way you spin it, it's literally left, right, and center. It's super undervalued, guys. And basically, what we were saying, if you're joining from X now and you couldn't see this, basically what we were saying here, guys, is that this 23 to $24 level, that's your resistance. That's kind of where we got up to, and then pulled back a little bit. And if you're not in this name yet, I do believe that you potentially might get a chance this week with the
Mhm.
things going on in the market, and we could have a pullback at least down to the 1924 gap fill, or if we're lucky, a 17.30 to $19 range for this dip buy box. Could it go down a lot worse if the market really pulls back like 6 to 7%? Of course it could. But at the same time, this is a health insurance company that their only revenue comes from the United States. And just because we're in war or anything else doesn't mean that the health insurance is going to go away. Does everybody think like that whenever, stocks are falling and cratering? No, they don't, obviously. But yeah, I think that was mainly everything that we touched
Yeah.
base on, as levels, right?
Pretty clean. That's
Sweet.
yeah. Quick, nice overview of what was screwed up.
Awesome. Yeah. So I guess this time I'll let you introduce yourself since I forgot to
Yeah.
do that in the beginning.
No, that's all good. Yeah. So Nick from Bull Trade Finder. But yeah, I mean, I'm a long-term investor. I'm a day trader. I trade spreads. I do it all. Let's just put it that way. I do it all. Um, and I'm just looking for the best opportunities, trying to share the info that I have. I've been trading for 10 years. I'm 27. I'm never 100% right. Anyone who says that is bullshitting themselves and bullshitting everyone around them. Um, but you just got to be smart, try to do the best you can, put in the work as you would at a regular job to, obviously make money, make good investments, and so on and so forth on that end. But overall, yeah, I guess that's a little bit about me. Um, we definitely have a lot of good stuff to talk about today, so we'll get right to it, I guess.
Awesome. Yeah. Yeah, let's just jump right into it. So, I got to be on Mitt's live stream the couple days ago.
Mhm.
Lost track of this weekend, honestly. That was really really cool. It was really really cool and like a great opportunity. I definitely feel like I didn't get to explain my actual bull thesis very well on there. I kind of let my nerves get to me a little bit, and I'm human like the rest of them, and it happens, right? But I really wanted to do this live stream. Me and you did a spaces. When
Yeah.
was that? We did that back in
Yeah, it was definitely March or February, something of that sort. It was a few months back. Yeah.
yeah, and we did that and we crushed it. We talked about, the fundamental analysis, we talked about the technical analysis, we talked about why this name was so undervalued. And you know, me and you weren't first. I actually got the name from you. I saw a post that you made about it, and then I did my research into it, and then we kind of talked about it, and then had a spaces. I think the long investor was talking
Yep.
about it before that.
Mhm.
Um, But yeah, I mean, a lot of people get caught up on the whole like who was first, who was, who
Yeah,
was
that doesn't
last.
matter.
It
Listen,
doesn't.
if
It
you're a
doesn't. It
part of
really
a
doesn't.
good investment, yeah, you know?
Yeah. It's a community, and like we need to all realize that Oscar has, almost 300 million shares traded.
Yeah,
So pretty wild. So it really doesn't matter. Only thing that matters is you do your due diligence before you invest into a company, and you basically take that time, you understand the business, and then once you're in, that way you won't get like shaken out, right? Because this thing is a $5 billion market cap, $5.4 billion market cap. It will have some shakeouts, it will have some ups and downs, just like we've seen with Hims. I mean,
yeah,
so many people have gotten shaken out of Hims left and right, like over and over and over again, and it's sad because they were down like $5, and then even if you're buying in $20, you're up 3x on your investment. Where we are right now. So it's just a massive opportunity over here on Oscar. And I actually got my notes here this time with the SWOT analysis. What I was basically trying to say on a midstream wasn't that Oscar's going to win in the long term only because boomers and that money's going to go to the younger generations. What I really meant by that was just saying that the Oscars, the Hoods, um the SoFis, they're taking in these younger generations, they're taking them in as clients, and that they are going to basically continue to win more clients and show them why their customer service is so great and why their integrations and their UI and why they should stick around with someone like Oscar instead of going over to like United Health or a Aetna or Blue Cross Blue Shield or something like that. And basically, once you continue to pull in, like we've seen with Hims and Hood, once you continue to pull in that younger generation and you show them the value of your product, then they're more likely to stay with you. And then what happens? Then they continue to grow up with you. And then as they do, come into more money for like Hood and SoFi and stuff like that, they bring that on over to the table. For something like Oscar, they're not really going to bring that over to the table. But what could happen is, once once the parents and the older generation, once their kids need to start taking care of them, they
mhm,
could transfer them on over into a company like Oscar because they're so used to using that product, and they would much rather use that product to help take care of their parents and have that insurance. And that's just one thesis of this whole thing. The bigger thesis is basically that Oscar is disrupting this dinosaur company. Hood disrupted the brokerage with free trading. SoFi is disrupting banking with just more hip, better UI, using AI to help facilitate some of their loan programs and to cut down on costs as well. And then you got like Tempest that's disrupting the healthcare, like pharmaceutical sector, and then Hims with their packaging and their UI. They're really going after disrupting kind of a little bit of healthcare and pharmaceuticals and that kind of realm. So when you have these legacy dinosaur companies that just aren't getting better, they're just kind of staying stagnant, they're fat and happy, and they're just sitting there like, well, we don't need to change anything, everything's great, even though our website is from 1990.
yeah,
It's okay, we're just going to keep doing our thing over here. And then Oscar, they're sitting there and they're like, man, like we could cut down on costs using AI, we could sit here and have less workers so our bottom line goes up, and we could sit here and use AI to help facilitate overall our products and making things seamless and easier for all of our customers, right? And by doing that, they're creating this flywheel effect and just basically giving people a better, more rounded option instead of, here's your insurance bill, here's your website, call customer service if you need anything. The younger generations really want things, right there at the touch of their
yeah.
fingertips. And that's what Oscar's really trying to do. So, yeah, what do you got to say about Oscar Bull?
I mean, I think you said, basically everything. But overall, I would say, the biggest thing that was, that started this run in the past, week and a half was, hold on, what was it exactly? I don't know the exact wording, but something got passed in, or is not being taken away from the government. Hold on, let me just double check what it was again. Or do you have it off the top?
They like changed up the bill. They changed up
Yeah,
something
yeah,
in
they're
the
not getting
bill.
rid of the Medicare Advantage. Is that what it was?
Yeah, that's what it
Okay.
was. Yep.
Yeah. And that was a concern, and that was a big, that's a big part of the business. So that overall was, really key into obviously what started this move. It was a risk that was taken off the table. Another thing that I want to say about Oscar is look at their CEO. Okay. So I think this is the most interesting thing. So Mark Bertolini, if hopefully I'm saying that right, former CEO of Aetna. Okay, obviously they got bought out. He was, oh my god, I can't find any of my stuff right now, but he was also a lead person at, oh my god, hold on, I gotta find this stuff.
I think it was Aetna.
No, yes,
Cigna.
he was the CEO of Aetna, got bought out by
Yeah.
CVS. He was also the CEO of an investment firm, and a really big one, or a
Okay.
decently big one. So he's had a really good track record. He's obviously done really well. I think he worked at Aetna for about 10 years before he actually got up to the position, if I'm correct. And I just think overall the leadership team that they have there is also very good. Obviously, there is ties to the government, within that leadership as well, the founders. So overall, I think leadership is good. Obviously, the steps they're taking going into the right path of profitability, which they already have, and continuing that growth. They're expected to have, I believe it's 22% revenue year over year this year was their expectations for 2025, as well as, yeah, Bridgewater. There you go. As well as the 600% EPS increase that they're going to have this year. The biggest thing is, they're lowering their costs, like you said, especially on the insurances. They're in the high 70s now, I believe, or maybe 80s. Again, listen, it's been a long weekend for me, but I'm gonna check. I'm
100%.
gonna
Yeah.
check out all my data in a second. But they're slowly every quarter taking that back 1% or 2, which is going to be key for obviously their growth. And as a healthcare, listen, I'm not a big healthcare person. I just love the fundamentals. I love the chart. I love the leadership, and that's good enough for me. Even if I don't know truly that much into a specific sector. Like, I mean, hey, I didn't know a lot into the health sector with HIMS. Same type of scenario. You have a great team, great products. I really have never really heard anything bad. Obviously, they're executing, and two, fundamentally, they're growing. So again, hits all the check marks for me. Same thing with Oscar. I don't know much about the sector that much, but overall, everything is starting to hit those check marks. And the growth that they have the past year going into profitability, this year with the continuation, and their expectation over the next 5 years is looking really good.
Yeah. I mean,
Yeah.
582% for EPS growth for 2025. Everybody's big scare on this is that for 2020, after 2025,
Mhm.
that ACA and basically that Medicare that they're talking about taking out of the bill. I don't even, big beautiful. I don't even know what the heck he's
Yeah,
calling
I think it is a big, beautiful bill.
it.
I'm
Okay.
almost positive you're correct.
Yeah, so he's taken they were talking about taking Medicare and some stuff out of that and hurt like basically gonna go after fraud and everything
Mhm.
and cutting back on that, which would have hurt Oscar a little bit. But a big comparison that I've seen and I actually agree with is that happening is similar to Hims losing GLP-1s.
Mhm.
Everybody was like, "Oh my gosh, like this is going to be the end of hymns, and it's like,
Yeah.
well, it's actually only like 5 or 6% of their actual revenue.
Yeah, I know.
It's the
That's
same
that's
thing
what I thought
over
was the
here.
craziest part. People were
Yep.
so freaked out about that.
Yep.
But there's alternatives. They have more products coming out no matter what, anyway. They're
Yep.
they're still growing at an exponential rate, even if that was totally taken out. Now, obviously, they have to deal with Novo Nordisk, but still, yeah, 100% good point, Ronnie.
Yeah. So, yeah, it's just one of those things that you have to, there's risk with this, but when you have a company that's this undervalued, when we just look at, again, I just completely took these numbers and went way against analysts on the revenue growth. I was, really brought it down. And here's the crazy thing. That's 0% revenue growth for the next 10 years, and it's still a $32 stock.
Mhm,
Explain that to me.
mhm.
Explain that to me. Because we're sitting here, and if you can literally put in 0% revenue on a company for that long, and it's still showing a $32 fair value, and we're not even there yet, what are we talking about here, man? Like the risk, especially whenever we were down at 11, 12, 13, 15, even right now at 22, this is what I'm talking about, is that the risk is still so minimal when we're talking about this company. Again, I don't like to sit there when people ask me like, "Hey, it's 22." Like, yeah, we've ran 50 some percent in 1 week. So
Yeah.
it's at 22 and you're asking if you should buy in now. If you're asking me based on the high five snapshot I have here, then yeah, if you have a 2 to 3 to 5 year horizon, like you're going to hold this company and you're not just going to go all in at 22, you're going to dollar cost average at 22. And as we go lower, right? Because here's the thing, everybody wants to try to time the market. And it's been proven over and over and over again that if you try to time this market, you're going to get burned in the long run. It's much better to sit there and have your investing side. And if you're a trader, have your trading side. Don't mesh the two. Don't try to be a trader with your investments and don't try to be an investor with your trades. And what that really means is if you get into a company for a trade, if things start to go against you and now the stock is plummeting or going down, and then your trading strategy tells you to exit, but then you spin it in your head into, well, you know what? Maybe I should hold on to it as an investment now. Nope. That's crossing two streams and it's not good. You're mixing salt water with not salt water.
Yeah.
And the same thing on investing side. I've seen so many people, they got all their investments and trades all in one portfolio, and I am always a believer that you should separate the two,
Mhm.
because what's going to happen if you have a bad trading week or a bad trading day or a bad trading month, you're going to sit there and you're going to be down, let's say $2,000. But then you're going to look at Oscar and you're going to be like, man, Oscar's made me $3,000. I could sell Oscar and then I could tell everybody that I had a positive week this week of $1,000. Or I could sell Oscar and be break even on the week. And then, I make myself feel better because, well, I didn't have a losing week now. And that is the problem with meshing the two, with investing and trading. And I know everybody here isn't both. And I know some people are one or the other, but that's just a very important thing that I like to say. But yeah, like if you're really wanting to know when you should buy this company, it's right here, right now, below $24. But don't just jump in full 100K like I did at like 15 something. Okay. Like dollar cost average into this thing, and don't try to sit here and be like, well, there's this gap still not filled down at 1331. There was some talks about it potentially being filled, because some people, like, everybody's different with gaps. Some people take this top wick as the gap, and then some people take the actual candle top wick, like the actual gap that it happened on. So I think you could do either. Either way, it could come back down and fill this gap at 1331. But even then, to sit there and only rely on gap fills, they really only hit, I think they've been studied like 50 to 60% of the time. So it's not
Mhm.
like this, like if there's a gap, it's 100% going to fill. Like that's not how this stuff works. So, yeah, if you want to invest in this company for the long run, do your due diligence. understand the company, understand what they're trying to do and how they're disrupting health insurance and going after these big Goliaths and, basically legacy brands that haven't really changed much over the years and are getting a lot of hate right now.
Mhm.
A lot of hate. UNH is getting a lot of hate. And I think that
Yeah.
one's undervalued too. And I think you could play both of these. I've seen people play, like Monster and Celsius. I've seen people play both of those together because it's like, okay, Celsius is the new guy trying to attack the Red Bull and Monsters field of
Yeah.
play. And then, Monster is the established brand that has all these other like Rain and Bang and they're the Goliath, right? And Celsius trying to take some of that market cap away. You could just play both of them. And I think the same goes for Oscar and UNH. UNH has taken a huge hit. You can get into that one, maybe a bigger position than Oscar, but then you can also have Oscar. And the good thing is you can win with both, or you could win big on one and then lose on the other, or vice versa, right? So you can win
Mhm.
big on UNH, it'll cover your Oscar losses. You could win big on both, and then you're just throwing a big old party. Or UNH can continue to have problems and then Oscar keeps eating their lunch. And I promise you're going to win way more on a smaller amount with Oscar than you will on UNH because UNH is a $278 billion market cap. Oscar's sitting here at 5.5 billion, right? A lot of runway, a lot of runway.
Yeah. And by the way, I liked what you said in the beginning. I mean, I do it personally as well. And it seems like you do. But yeah, I separate my account. So if I'm, trading, it's another account. Long-term investing, another account. And then I have my IRA. So yeah, I do the same thing. I think that's personally the best way to do it. I like that comment.
That's a funny comment. If choose one, Oscar, Root, or Lemonade. I don't know Root. I know Lemonade.
Yeah.
I'm
I
still
know
deep
Lemonade
diving
has
on
a history.
Lemonade.
Yeah.
Lemonade's numbers do not look like this. Okay.
Mhm.
That's the big thing. Here's my biggest thing on Oscar, man, is like how often do you see, Nick? How often do you see a company that's massively undervalued like this on like all metrics and then actually gets hype behind it? Because we can like throw out like a PayPal. We can
Yeah.
throw a PayPal out there, and they've been massively undervalued as well for quite
Mhm.
a while now, right? And I think they're undervalued too, but they just can't
Yeah, they
like
can't get going.
they can't get going. They
Mhm.
start and then they topple out real quick, right?
Yeah.
And there's a lot of other names too. Like Intel was one for a little bit, like, oh, they're so undervalued, they're a massive chip player, like blah blah blah. But then it's like, well, they can't get going. And a lot of those value plays, a lot of people throw the value trap name around a lot. Micron, I don't know if you remember that one. That one was like everybody was like Micron's a value trap, and you look at the numbers and it's like, man, it looks really good. But then it's, everybody's like it's a value trap, and then it ended up running. It just took a long time. It just took a long time for it to actually get running. So it's one of those things that you don't really see a name like this, be so undervalued and then get a lot of hype around it just out
Mhm.
of nowhere.
Yeah,
Yeah,
I
even
agree with you.
hymns, even
Yeah, I was gonna
hymns,
say hymns, yeah.
um,
It took a while.
it took a yeah, like I mean, they went down to what, $3 at
Yeah.
one point or something like that,
Again, a
and
company
the
that is
numbers
growing
weren't
exponentially. Yeah.
yeah, and the numbers weren't great in the beginning.
Correct.
That's the biggest thing is like typically here's my main point. When you get something like Oscar that is EPS positive, that is free cash flow positive, you run pretty much every metric and every ratio and it's telling you it's a screaming buy, but then you sit there and say a different company is typically if you want this type of run or this type of, move, typically that company is EPS negative, free cash flow negative. They're not a profitable company and they're burning through cash like crazy. And you have to take a gamble. You have to sit there and take a gamble at are they going to become EPS positive?
Yeah.
You can see the trajectory of that happening, but one small slip up and then it's back down to a quarter over quarter or year over year bigger loss
Yeah.
of net income. So that's really my point here is that typically to get these crazy, like, hype names or to get these outlandish moves, typically you have to take a lot more risk in those names than you do with something like Oscar. To me, I look at Oscar and I say, how much risk am I really taking? I couldn't even imagine this thing breaking that like $10 or $11 level. If it did, I mean, they would literally have to, like, something royally, like, would have to come, like, just not work out for them. They would have to lose ACA, and then ICRA would just have to fall apart, and basically a lot of just policy changes would have to take place. Yeah, you typically don't get, something screaming undervalued, and then it can also go on a massive run because it's a cheap market cap.
Yeah. And so here's what I like to do as an investor. I love the companies that are either just turning a profit and are showing continued growth with a good team, and or they've been profitable for a few quarters, something like that. I was in PLTR before it went profitable. I was in HIMS after it went profitable, I should say. I was in Oscar before it went truly profitable, as it's going to be this year. And I feel like there is other companies that I've been in. It's definitely been one or two more that have done really well. And I think I love the story. Turning around, great team, great execution, and you're turning profitability, and now you're continuing to grow and execute on that profitability, quarter after quarter, year after year. I think that's a big thing. And we have, again, a name like HIMS that has just continued to do it quarter over quarter, year over year, and just continue to grow. And now they're really starting to take a large market share. One second.
Yeah. Yeah, 100%. If you just saw on the screen, I was showing, somebody was saying, Nick was saying HIM's at $3. Yeah, I just showed it on the screen. I could show it again, but crazy that it did actually get to $3 here. If you look here on the chart, in 2022, May 2022, it hit a low of $2.72. Imagine getting HIMS at $2.72, and it's $64 today. Crazy. But so I'll bring up my high five snapshot here, guys. So what I really want to talk about, this is something new I actually just added to my overall high five snapshot. I was sitting there and, I got some good feedback from the Emit live stream. And, people were saying, hey, don't overcomplicate things, just give your main points. Just give your main points of why you're bullish. What are the risks? And, I've always done SWOT analysis, strengths, weaknesses, opportunities, and threats. I've always done that for my companies. And I sat here and I was like, I got all this empty space down here. Why don't I just add it? Right? Why don't I just add it down here? That way I have it, in every single one of these stocks that I'm looking over. I can just sit here like, getting into Zeta and doing my analysis on that. Anything like Google, Snowflake, I can add this in down here and basically just have my quick and easy. Hey, this is my, these are my 3 bullet points, keeping it the 3 bullet points for strengths, weakness, opportunities, and threats. So we'll just go through those real quick. We'll talk about the valuation a little bit more, and then probably open it up and see what the chat is talking about. Zeta's not done yet. Yeah, Zeta's not done yet. Still running the numbers and punching those in there. Yeah, so we'll get to those. But still doing my research and DD on that. It's tough, guys. I'm a father of 2, and I have a wife, and it's crazy. I've really realized that there's only so much time in each day. So it sucks. I wish there was more time in each day so I can get more done. Either for the community or you guys and posts that I make. And then also got to do due diligence, and I'm also a trader. So it does get difficult at times, but hey, we press and we do as much as we can, right? So one of the strengths that I have here is tech-driven member experience. So they have telehealth claims and care navigation. So basically, like we were talking about earlier, they have a partnership with OpenAI, and with that OpenAI partnership, they're really creating these telehealth claims and care navigation. They're really decreasing the amount of workers needed to run these programs, and obviously they are decreasing the amount of time that it takes, and like creating a great UI to make claims seamless and easy. I know a lot of I know a lot of car insurance companies. My personal one, I can go on there, I can go on the app and I can just punch in real quick, like, hey, yep, I need to make a claim. And they could do that real quick, easy, and seamless. Introducing AI to that really helps overall with the UI, and making that a lot seamless and easier process. Auto filling things in, having AI help you with any questions you have. Makes it really easy. Personalized and preventative care focus, data tailored care, reduce costs. So basically, again, with the AI, artificial intelligence, they're using your data that you have through their app and through your insurance and other claims that you've had. They're using that to basically make, um, you know, give you a more focused care plan. So whether, me recently, I've been having some back issues, so it could be something like, okay, well, hey, for your care plan, boop, 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 like this is your diagnosis. Like you got some back spasms going on, you got some mid back pain going on. So your care plan, with AI integration, it's just going to sit there and say, okay, first we're going to take some X-rays to make sure nothing's broken. Then you're going to go over here and you're going to do some physical therapy. And then you're going to do physical therapy for, 6 weeks, 8 weeks, 10 weeks, and they might even be able to mesh and partner up with Hinge. I don't know if you guys have heard of Hinge yet. They're a brand new IPO company. They're basically attacking this like physical therapy market, and they're trying to do online physical therapy. Now, just right off the top of my head, I'm not like a huge fan of that, because I'll be totally honest. When I was going to physical therapy, there was times that I'm supposed to be doing exercises at home, to help my back heal. And was I doing all of them? No. So
Yeah,
in my mind,
I've
I'm
been there.
sitting there and saying, okay, if I'm supposed to be doing all of these, right? If I get this virtual thing going on, if I can't do it on my own time, am I gonna log on? And that's just my own like little like bias against that real quick. But that'd be really cool if OSCR partnered with like Hinge, and those are both like two like mobile AI using health care companies. The small guys should just all partner up together. Honestly, if we can get OSCR, Hinge, Hims all partnering up together to create, not meshing together as companies or anything, not
Yeah.
acquiring each other, but just basically like, hey, small guy, like, Hims is over here, like, you really paved the way for all of us. So they could sit there and say, hey, we would love to partner with you and, have a lot of your health insurance flow through Hims. And, yeah, I think it could be really, really good. So yeah, data tailored care, X-rays, and then PT. And then guess what? If that doesn't work, we're going to schedule another appointment, a follow-up appointment with your, um, with your,
Provider
provider. Yeah.
or
I don't even know.
physician.
Yeah, I
Yeah.
don't even know the guy that I talked to. I don't even know like what's a back specialist called.
Uh,
Whatever. Yeah.
orthopedist?
So
No, not
yeah,
orthopedist. I don't know. Yeah,
yeah,
whatever.
some like yeah. Actually, I think it is orthopedic. Yeah,
Is it?
yeah, I think so.
Okay.
But anyways, yeah. Okay, now you're gonna talk to him, and then you're gonna turn around and for me, they were like, "Hey, how's PT going?" And I was like, "It's good. My back's almost fully healed. We're good to go." And he was like, "Okay, well, did you want to get an MRI? Did you want to, get further? Did you want to start getting like the cortisone shot?" And I'm like, "No, I don't want to get cortisone shots in my back. Like I'm 31, I'm good." Um,
Yeah.
so PT's working great. I just need to do more of the workouts. It's my own thing. So yeah, basically it could look something like that, right? Oscar just sits there and spits out to you through the AI, like, here is exactly what you're going to do. Instead of needing
Mhm.
to go to your provider and then tell you specifically, okay, now you're going to go here. And then up, it's not getting better. So you go back to your provider and you say, hey, my back's still not better. And they say, okay, well, now you're going to go over here. You see what I mean? It can get a lot of like you traveling, spending gas money, which gas might be going up here pretty soon. So That's not fun. So imagine just like an all-in-one app with Oscar for your insurance. You can do your claims. You can have like a game plan for the your health plan, like for your physical therapy, for your back pain, for your eyesight, for whatever, right? And then third on here, we have transparent and user-friendly design. This goes along with what I was talking about before, winning people over through customer service. And yeah, Chris brought up a great point. Too much AI on a myth stream. Too much AI can be a detriment. I cannot stand it when I really need to talk to somebody with
Yes.
customer service and I can't. Like
Everything's
I
like that
cannot
now.
stand it. Yeah, everything is like
Yeah.
that. And so I understand his point, but like you just said, everything is like that. So like think about all the ads you used to not get.
Yeah.
But now you get a million ads on everything. I'm watching YouTube TV and it's like an ad every 2 seconds. And I'm like, well, what's the point of streaming?
Yeah.
It's the same thing as cable. YouTube
Yeah.
TV is cable with like maybe more commercials now. So it's like, hey, we're going streaming for cable, but it's the same thing. You still get a million ads. On YouTube, I don't have YouTube Premium. And oh my goodness, it's like an ad every 2 seconds now, where like maybe a year or so ago, it wasn't like that. So that goes along the lines of what I'm trying to say here is that, it sucks, but it's one of those things that everybody's just gonna have to get used to. Like you're not gonna talk to people all the time. As AI advances, though, as well, they're gonna get better with customer service, and they're gonna have some person on the other line with this perfect voice, and they're gonna be like, "Oh, how can I help you today?" It's we've all seen those AI videos or
Yeah.
the fruit cutting videos now. Like they're getting crazy, like ASMR fruit cutting for glass or whatever. I don't know.
There's a ton of like realistic videos. Like I saw one today on TikTok. I was just scrolling for a minute, and it was a AI video. It was high definition.
Yeah.
Words were matching the mouth. Everything.
Yeah, it's absolutely wild. So,
Hmm.
yeah, those are my strengths for the company. Would you have anything to add? And I tried in my SWOT analysis, I try to keep out any of the fundamental numbers just because I have them all right here in the high five snapshot. So like I don't need to say that they're about to increase EPS this year 582%. It's already right here. I want a SWOT analysis on the actual company, like what they're doing, where they're going, what are some headwinds, like weaknesses. Definitely. They're not in every state.
Correct.
But that's also an opportunity because they could
For
get
expansion.
into every state.
Yeah.
And let's
Expansion.
be
I mean,
honest here, to have this fundamental outlook and you're not in every state, okay, like that is phenomenal. That is phenomenal to be this undervalued and not be in every state and have that opportunity. Another weakness would be brand recognition still growing. Obviously, they don't have the brand recognition of Blue Cross or UNH or Aetna or Cigna. They don't have that, obviously. But if you see what Hims has done with marketing, this is why it'd be great if they could like get in with Hims. But Hims spends a lot on marketing, and it's something that people bring up as a bear case a lot. But honestly, they're going in super growth cycle right now.
mhm.
And I'd rather them be spending all this money on marketing than, just diluting the heck out of all of us shareholders. They're diluting a little bit like every growth company out there, but man, I love the fact that they're attacking so viciously the marketing side
Yeah,
of
and they've
things.
been Hins has actually been lowering their marketing expenses too, which is funny enough. And
Yeah.
um, I think I know I keep going back to it, but I think it's so relatable to Hims in the fact that you know, like you said, they're not a name brand, and again, Hims is becoming that.
Hmm.
Oscar could potentially be that. There's something you said just a few minutes ago, not a few minutes ago, like literally a minute ago,
Yeah.
that I want to comment on. I already lost it. Like I said,
It's been a
crazy weekend,
long week. Last week, oh
dude.
my goodness. I went through the ringer last week on trading, the ups and downs. I mean, I feel you, man. I feel you. There's
Yeah,
so much stuff going on. Um, And yeah, I mean, me and you and the long investor, I'm sure there's others out there, but we were, and I hate being like we were first to the party. Like it doesn't matter. But like a lot of people, we posted a lot about this company.
Yeah.
And now I don't know about your ex, but mine's blowing up. Like I'm getting so many people, DMing me, and I'm trying to comment back to everybody and reply back to everybody. And this is
Yeah.
like the busiest I've ever been on social
No,
media. I'm
listen.
just like, oh my gosh, it's crazy. Like it's awesome. It's awesome, like how
Yeah.
big the community is growing. It's also awesome. You can speak to this too. I love it when other people make money off my DD or due diligence or trade ideas. I love when other people or my community members make money more than I do, like more than me making money. This is one of those things that's
Mhm.
super cool because you know you're helping somebody else. You're
Yeah.
helping somebody out to and they're making life changing money or just like a massive amount of money, and they're working a lot of them working 9 to 5s, and you know they can really go buy something nice for them or their kids or their wife, and it's just really 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 cool. I'm
Yeah.
sure you can speak to that as well.
Yeah. It's been crazy. Again, like I said in the beginning, it's been an amazing 2 years for, some of these so for some of these investments. I would say the best feeling is exactly what you said, being able to help others. That's exactly why I post. Listen, I could do everything on my own. I love talking to people. Again, it's like a job. I treat it like a job. This is what I do for a living. I have real estate on the side, but this is what I do for a living. I want to connect with people. I want to get smarter. I want to help people in what I know, and being able to give out specific, information that I believe has helped me, that I believe is correct, and hopefully accelerate or change someone's life or something of that sort, help someone out, is amazing. I wanted to be a financial advisor. I went through college, got my
Same.
degree, um, did interviews, and then, I got accepted to a few in the city in New York, and I just decided, you know what, I, I'm gonna I'm gonna bet on myself. I feel like I've
Love that.
done really well already. I've been trading since that, late junior year of high school. I went through 4 years of college. I did really well in those 5.5, 6 years. I set myself up. I'm going to give it a go. And, it turned out to be one of the best things, to happen. And I'm so grateful for all the people I met along the way. Again, I would have never have known who you are, Ronnie, So
100%.
always amazing to see those comments, and again, over the past week, especially for Oscar on the way it's moved, it's been one of those, types of or times, like you were saying.
Yeah. And I'm sure I already know this, but the passion, I'm sure you're just as passionate. Like
Yeah.
I love it. I eat, breathe, and sleep stocks
So
in
yeah,
every like I love it so much.
no, 100% same here. And I'll be honest, like I was only a day trader. I wish I invested when I was in high school and college, to be honest. I did start actually investing after college. So only a few years back, maybe 3 to 4. Well, actually probably 4 to 5, but um, if I invested back then when it was 2016, 2017, hey, I could have my investments and my prices for those could be insane. But I'm happy on the road that I took, and overall, now I'm honestly starting to become more of like an investor. And I've been selling options for the past 5, 6 years. I'm really primarily doing that a lot now. Here and there, yes, I'm day trading, but not as crazy. And I'm just doing some futures. So, it's crazy how things change, especially over the years, where I was day trading every day. I wanted to be in a trade as many times as I can. I know that's not the best thing. That's something you learn. That's something you grow on. And I hope if you're out there and you're struggling, play smart. Again, your money's at risk. Be patient, size appropriately. you know I have lost a ton of money in the market. Luckily I've made a ton of money in the market. But you just gotta understand that these base hits, count, especially for those people who are day trading, swing trading. Listen, I don't know anyone's account size, but 250 a day, 500 a day, depending on your account size, 1,000 or 2,000 a day, that adds up. You don't need to shoot for, oh, look, this guy made 1,000%. And I've seen some of those this week on OSCR, people making 1,000% on options. That does not happen every day. That does not happen every week. That doesn't even happen every month. I think I've maybe had a couple of 1,000% plays in my 10 years of trading. And it just may be the way I trade, but it's something
you're gonna get it more in like investing long term and like getting those 1,000%. Like my day trades and stuff, I'm usually hitting, between 10 and 30 to 40% on options for a day trade or something. And like swing trades, same thing, usually not getting like, big, sometimes I hit a home run, but not all the time. But yeah, that's super awesome, man. Yeah, I kind of did it opposite. I started investing and like really doing deep dives and watching a lot of those guys, like I said, like Amit and financial education and all that stuff on YouTube. And yeah, my big one was like back in 2017, 2018 was like Tesla. I saw it and I just fell in love and I did all the research on it and I made just crazy gains on it. And I was like, this is cool. I like that. Like put in 11,000 and it runs like 300 plus thousand. Like that's cool. Nice. Okay. And then, I did time Tesla, I did, say, okay, well, as I continue to learn and get better, just sat there and was like, this is, pretty expensive. And, just based on everything they were doing, I decided to sell out and then bought back in the hundreds and then rode that up. Not perfect, guys. I didn't like bottom and top and all that stuff. I probably sold way off the top, but and I recently sold Tesla. I'll be completely honest. I recently sold it with all the stuff going on with Elon, just because I sat there and it was getting pretty crazy. And I sat there and I just said, he's absent. He's not fully there, and there's so many better opportunities out there. So I decided to sell. As soon as I sold, he came back.
Yeah.
Look, it is what it is, guys. Yeah. You can't be in everything, guys. That's the big thing here. You can't be in everything.
Yeah.
You gotta play to your books. And yeah, just be careful out there too. And I hate saying this, but like there's a lot of like, I mean, you see how good AI is. There's a lot of photoshopping going on out there. It could be really bad. So just be careful out there, guys. Be with people that show what's going on, the ups and downs. Like, it's
100%.
It can get really bad. I lost a decent sized chunk trading in the beginning of this year. I've gotten it back since then, which is great. And that just shows resilience. It's like to myself. Didn't blow up an account or anything like that, but that tariff took. I was in a lot of trades, and that tariff stuff came out, and market started taking a crap beginning of the year, and things got bad on the investing side. I just kept buying more, but on the trading side, when you're in a ton of trades and the market does that, if you're in a bunch of trades and you can't do anything, and then Monday morning it opens up and tanks, yeah, you're gonna take a hit. I'm sitting here now learning from those lessons back then, sitting here now looking at Monday saying, I don't really know what's gonna happen, but if it tanks, I'm not in a lot of swing trades. I'm not in a lot of long-term trades. I've been day trading a lot. I'm in some investments, but I have a huge cash position on the side ready to buy this dip if we finally get one. Who knows? Because this market feels like the money printer's going on. It really does, because every little dip, it's like snaps right back up, and we're getting like these wick downs and wick right back up, and it feels like the money printer's on, but who knows? All I can say is, you should always have some cash on the side, especially that we are, running into all-time highs like we were. I never try to be a bear. I just try to warn people. Like I was warning my community, like we have a rising wedge going on, and we need to be careful because we did break down out of the rising wedge.
Yeah.
And we did have a lot of other bearish signals. I don't know if you saw on the weekly, over the last 2 years, we've had 3 other inverse red hammer candles, and every single one of those led to at least a 8% or more pullback or correction on the QQQ.
Mhm.
And we just printed one 2 weeks ago. So I was looking at that and just like, yeah.
Like a hanging man? Hold on one second.
Yeah, similar. Yep. Inverse head and shoulders. Or sorry, inverse hammer candle.
Yeah, I see. Yeah.
I can pull it up. Let's see.
Oh yeah, I got it.
Yeah.
Oh yeah, you can pull it up for others, but yeah.
Let's see. Yeah, so look how crazy this is. So if we go to the charts here, every one of these arrows. So hammer candle, the next week we popped up and then we had the pullback over time of 11.48%. And then hammer candle right here had a pullback of 8.63%. Kind of hammer candle. That was kind of like a doji top, I would say, more so. 16% pullback. And then right here, that was actually, it's like a double hammer candle right here on the weekly. So it just doesn't look that great. But we'll just see what happens. But you get these V shapes, and if you can't break over this top and you're just making a lower high here, typically you're going to roll back over and get some sort of dip and then another run up maybe to break over those highs. Yeah. I don't know what this market's going to do. You don't know what this market's going to do. It's been absolutely crazy. We have dips. We have gap fills to go fill. There's so much stuff with this market. There's so much economic. There's potential housing stuff going on. I don't know if you saw down south. There's a lot of housing that's being rapidly decreased in price because they built so much.
Yeah.
So you're just having this. It's not up north. The houses up here in New England are still like flying off the shelves, like bidding wars and stuff. But if that starts creeping up north and out west, then we could really have a big problem in the housing market. We could creep into some issues here. It doesn't take much for unemployment to start rising pretty rapidly. There's I call them landmines. There's a lot of landmines out there that could potentially get this market to move down rather quickly. And something not a lot of people talk about. A couple people were talking about it on X, but like realistically, we only have one trade deal. Can we talk about that?
Yeah. I mean, we have.
So
UK you're talking about, right?
Yep, UK.
Yeah.
That's the only like legitimate trade deal that we have on the table right now. So
yeah.
If that pause gets rolled back and we go back to 100 and some % tariff on whoever, I don't know. So
yeah, I also think those headlines are starting to get a little tiring. Not really doing that much. Obviously, yes, it's having an effect, but it's not as much as it was in the beginning. That's another thing I think of thinking of when we hear tariff. But still, obviously, it matters. Yeah.
You just want to throw up. I'm so sick of that word. It's like transitory. You remember in 2022, it was just they just kept on saying transitory. It's transitory, and I was like, shut up, stop saying transitory. Like you just keep saying it. It's so annoying. Oh man, it's not transitory because inflation ran to like 11% or something. Like, come on.
Yeah.
Yeah, it is crazy. The market's crazy. Sorry, I went off a little bit there. Other weaknesses for OSCR would be operational complexity, and basically that's just talking about regulatory compliance issues. Anytime that you have healthcare and AI and data and people's personal information, gets a little dicey. Okay. It can get into HIPAA stuff. It can get into violations, especially if they get hacked or if the AI accidentally sends it to the wrong person. Like if they sent me your medical issue or your medical report accidentally, and AI was like, whoops, like it's definitely not. There's a lot of things that can happen in there. Obviously that could cause more issues like we already talked about before. And we talked about this back in February, remember, or March on our other spaces, the SEC investigation. Remember we talked about that back then?
Yes.
because everybody was talking about it then. Nobody's talking about it now, and I think that says a lot. Because I don't know about you, but I don't really view it as that. I know it's something like, oh my gosh, like SEC's investigating them. But
Mhm.
again, I went over it and we went over it, and look, it's like a he said, she said type thing. Like they're just talking about, you know, oh well, you might have misled investors during COVID. Like, well, they probably
Yeah.
didn't even know what was happening during COVID. Like no one else, like everybody else didn't know what was happening. So did they really mislead you, or are they just a normal company that had no idea what was going on and they were just trying to do their best, right?
Yeah.
So, um, the ACA is like, that's a risk that
Mhm.
everybody always brings up. Um, yeah, I don't think ACA is going away. I think that the biggest fear of it was that Medicaid, um, basically the fine print of it, them trying to get rid of some of the fraud and lower income people getting that health insurance for free, and a lot of Oscar's clientels
Yeah.
is that like they're
Right.
they're getting free healthcare off the government, so they're not having to pay, but Oscar's still getting paid. That
Yep.
was the whole thing, that they're like, that everybody's like, oh my gosh, if that goes away, they're gonna be SOL.
Mhm.
And I just don't think that's the case here, especially now that they changed the bill. That's what started this whole ripper rally. It wasn't me, it wasn't you, it wasn't the long investor, it wasn't any of us that was like, okay, guys, I'm gonna post my 50th piece of information on Oscar, and this is the one that's gonna get this thing pumping. Like, come on.
Yeah. No, not
There's
at
a
all.
4 billion, $5 billion market cap. Somebody was like, someone called me a pumper, and I'm like,
I saw
okay,
that. That's
yeah.
yeah. That's stupid.
Like, dude, I couldn't pump a penny stock if I tried. Like, come on, what are we talking about here? Oh my
I
goodness.
saw that.
We've been talking about this name, since February, maybe a little before that, and like, dude, I made a post too. It was like, yeah, I bought 100K, and I think I'm down to like 70 or 80K. Like I was down like 20 or $30,000 on Oscar at one point during the April lows. Like it sucked,
Mhm.
but I kept dollar cost averaging, because that's what you do whenever you have this conviction and you understand that. Okay, I was fully ready. I don't know about you, but I thought things were only going to get worse. I
Yeah.
did not see like this V-shaped recovery. I was
I
like,
didn't
yeah,
either.
yeah. I don't think
I thought we
anybody
were going
really
down
did.
more.
I mean, if they say they did, cool, whatever, good job. But
Listen,
everybody's a expert in the predicting the markets after after
yeah.
the move.
I
So,
mean, I'm happy. I did buy some stuff. Like I had AMD at
yeah,
88. I had Hood at 38. Like I did have some good buys. I was only nibbling and slowly adding in because again, I didn't know. No one knew that we were gonna basically come back to all-time highs almost.
yeah.
So again, it's just part of the game, but you just got to be smart and allocate where you can, when you can, in decent opportunities.
Yeah. I mean, I was buying, I mean, the Mag 7s were so cheap. They were
Yes.
so cheap. I was buying, so I don't know how you invest. I
Mhm.
do some dollar cost averaging, but
Yeah.
I mainly, like when I'm building portfolios, I'm mainly doing it based off margin of safety, which
Mhm.
basically is just, okay, if I have a fair value of $815, I want to buy at a margin of safety. So meaning like a 20% discount. So you go
Okay.
to the store, you go to Nike, right? And you want, the brand new Air Jordans. Well,
Yeah.
do you want them at a 20% discount, or do you want them at, asking price? Or worse, do you want to overpay and basically they're all sold out and you're buying them off eBay for some, someone who bought them and then up the price. You know what I mean? Like PS5s and all that stuff. Remember, every time they come out, everybody buys them all up and then
Yeah.
jacks up the price on everybody. Yeah, that's
Yep. I
basically
know.
this. Yeah, that's a similarity of paying over asking price of a stock, over its fair value. I like to start my position at 20% margin of safety.
Okay.
So on um on let's see, open up my Discord. On in the public portfolio, it got to, I basically built a 60% position in Meta, Amazon, Google, PayPal, a lot of these companies, because I build a 60% out position once we get to a 40% margin of safety. I fully build a position when we get to a 50% margin of safety.
Okay.
Just because at 50%, you're getting 50% off of this thing. Don't be greedy and wait for like 60 or 70% off, because you're probably not going to get it. I mean, imagine Meta going to $244. Good luck. We're gonna need some real bad stuff to happen over here for that to happen. So, even like, 50% at 141, we got down close to there on Amazon, and 70% was 85 or whatever. But that's how I basically buy. Do you just dollar cost average, like find a name you like and then just start going in, figure out what your starting price is, and then DCA?
Yeah. So, put it like this. Okay. We talked about Oscar in the beginning. I said I'm perfectly fine with still adding shares, on a dip, because I still want more of my position. Yes, I have good averages around 12 and 13. I've had some buys in the 14. I've had small buys in the 15s. And now, again, at this point, if I was, I'm in this position. Okay. I think, possibly we get a pullback. I know you kind of feel the same. I talked about, $18. I talked about $19.24 and $19.79. That's where I'd look. Okay, I feel like I'm going to put some buys in here. We're looking, we got the pullback I wanted. My averages are still good. I'm accumulating the shares that I want. And I still believe that, this has 50 to 100%, opportunity to the upside, in the near future or in 2 years. And, I think it's going to make me money. Obviously, I like, where the company's going. So something like that. Yeah.
How do you feel about like, I think you just basically said it, but how do you feel about having such a low cost basis
Mhm.
of $12 to $13, and then how do you feel about continuing to buy knowing that you're going to increase that cost basis?
Yeah. So I think it's crazy because it keeps coming up, but I think this is a perfect example of what I did with him. So my initial buys were in the 16s to 17s. My current averages are around like 24. And that's when him's honestly got to about like 25, 26, 27, 30 on that major dip, you know? So I really averaged up on that. I think one account I have 21. And when I say the two accounts, one of them's IRA, one of them's the long-term one. One of them is in the 21s and one of them is in that like 23 range. So yeah, it doesn't bother me that much. Again, if the whole entire play is still there, everything that the reason why I invested in is still there and, improving, I'm going to stay in it. I'm going to obviously execute on what I believe, what I know, and what I hope can happen. Hope may not be the best word, but yeah.
Yeah. Well, I have it right on my screen, right? So my fair value still so it was lower, but then after the recent quarter and the phenomenal numbers that they produce, that's a great thing about this is I just continuously punch in the new numbers, right? And then when I punch in the new numbers, 102 fair value on this thing. If you're going off a discounted cash flow model, if you're going off an EPS model, it's a little expensive. But that's because here's the key difference. Right now, Oscar, analysts don't even have out more than a couple years on Oscar. So I don't really know. I can see them doing 20% revenue plus.
Yeah.
Honestly, because they're so small, which would be huge. Which if that happens, that means that Oscar, the 10 multiple that I have for them should be a 20, 25, or 30. If they're growing 20% plus, you know what I mean, in a growth beast. So like someone like him's that's going to grow 20%, 30%, mid 20s, right? And then when it gets not so great, it'll be high teens. I mean, we're looking at such massive undervaluation, but not just that. You can, but I don't like to base a major growth company like this off of EPS. I don't know about you. I don't
Okay.
like to do that. If you did that for like Palantir, you wouldn't have bought Palantir in the 20s, the 30s, the 40s, the 50s, the 60s. You would have bought Palantir, in the fives and tens, maybe if you saw it that early. But you
Mhm.
know what I'm saying? Like you missed out on a massive opportunity on Palantir if you're sitting there saying the PE is way too high. Like I
Yeah.
get that, but value or growth companies should really be valued based off peg ratio and dollar cost and this kind of cash flow. What do you think?
I think that's a good explanation. Um, so I'm looking at it multiple different, ways of when I'm investing. I'm looking at
Yeah.
obviously the revenue growth, their EPS growth, like you said, the free cash flow. I
Yeah.
think the free cash flow is a big part of my investing. Um, yeah, I think you put it in a pretty good way.
Okay, sweet. Um, yeah, just because like if you look at here, right, with a 40 PE and a 30 PE here on HIMS over the next, 5 years, we're already over the fair value. So with being over the fair value over the next 5 years, if you're going off EPS and you're sitting here selling HIMS right now, if you're going off a peg ratio that's 0.60 and you're going off a discounted cash flow model, which is 102 fair value, then you're basically sitting here and you're a buyer because it's a 37% margin of safety right now for this fair value on HIMS. So, it really just depends on what you're looking at. But the great thing about Oscar
Yeah.
is the fact that you literally have a it's a buy on a discounted cash flow model, it's a buy on a peg ratio, it's a buy on a free cash flow yield ratio, it's a buy on a price to sales ratio, it's a buy on even a forward EPS. Because I'm basically
Mhm.
getting, basically $30 for 2026 is fair value on this company. And that's still about a 20%, 20% cheaper than where we are right now. And you can see the CAGR rates, 20% CAGR, 14% CAGR on EPS for the next 10 years. I mean, you're going to handily beat the markets. And look at these revenue growth rates that I have in here. 22% for this year, a negative 2% next year. And that's like worst case, like say like the ACA stuff, or they end up putting that stuff in the Medicaid, Medicare bill in there, and then they lose some of that money from the government and people don't re-up on their insurance with Oscar because they're not getting it for free anymore, or they don't want to start paying for it, with Oscar and stay with them, which I think a lot of them actually will because of the UI and because of, how seamless the
Mhm.
app is. But then going down to 14, 10, 8, 12, 8, 10, and 6.
Yeah.
Like these are crazy low revenue growth rates for a $5 billion market cap that is only in a handful of states. I mean, if they went across all the United States,
Mhm.
I do not see how they're not growing like 20, 30, 40%.
Yeah.
You could see something like Palantir, not like business model wise, but growth wise, where everybody's like, oh, Palantir's growing 20%, like they're expensive. Oh, Palantir's growing 30%. Okay. Now it's actually, whoa, they're not as expensive. And then they're growing 40%. And you're just sitting there like, oh my gosh, I was so wrong on this.
Yeah. Oh my God. That was,
Because I was in Palantir too in the 20s, and that was a great investment. But then
yeah.
basically this current margin of safety or current margin of risk, I use
Mhm.
this. I'll punch in like really like very very bullish assumptions on everything, kind of like getting a little bit crazy on my assumptions
Mhm.
for the margin of risk percentage. And if this is telling me to sell, trim 10%, 20%, or 100% on my position, I go ahead and do it. Because
Yeah.
if I have to punch in like crazy numbers, like in Palantir, like looking back on this, I should have been punching in like 50%, growth rates or 40% growth rates, not 30 or 40%. Because I did end up trimming and getting out of most of my Palantir. But it is what it is. You got to move on. Um, I guess we could take some questions now.
Mhm.
You know, real quick, just go through the rest of this SWOT and then we'll go through some questions. You guys can start putting the questions in here now, whatever you guys want to ask, whatever you're feeling about Oscar. Um, Opportunities, obviously, like we said, expansion into more states, partnerships with providers and employers. So we're talking ICRA and ACA, Affordable Care Act expansion, AI and predictive analytics, leveraging data. That was kind of what we talked about over here in strengths. Just continue. If you look at their SG&A, they're just simply crushing it compared to like UNH and everybody else because they're really leveraging that data. Like UNH has so many employers compared to OSCR, and basically their dollar per employee is way higher than UNH right now on a percentage base, not actually on like a because they're 278 billion dollar market cap. Intense competition from UNH, Cigna, Aetna, and Blue Cross, like we already talked about. It kind of goes like with the hymns, like, okay, oh, Amazon's gonna eat hymns lunch, Amazon's gonna crush it. And it's like, okay, well, like when I made my video on hymns way back when, I basically was like, I pulled up every single business that Amazon was in. And I said, look at this. Look at all of these businesses. It was like a long page of like over 100 businesses. And I was like, they are going to focus on their 3 core businesses, and everything else is kind of like throwing darts at a board. While Hims is deadlocked, focused on one thing, one business, right? So when everybody's sitting there like, oh, Amazon's going to kill him, blah, blah, blah. And I'm like the short attacks came out over and over again.
Yep.
And by the way, I'm waiting for a short attack on Oscar.
Yeah.
And I won't even be mad. I won't even be mad. I'll be sitting there like, buy. I mean, bring it on. Bring on the short attacks. They do them for any company that starts getting hype, and then a bunch of people sell, and it's a buying opportunity. Regulatory shifts. We already talked about the new Trump bill. Too much AI. We already talked about that too. Sweet. So we already went through our SWOT analysis. Covered this extensively. Where we're at with everything. The craziest thing, guys, is 9.2. Actually, they're up to like trailing 12 month. They're up to about 10 billion, a little over $10 billion in revenue.
Yeah.
And they're a $5.4 billion market cap. That's crazy. When they were a $3 billion or $4 billion market cap, I was sitting here saying they have $1 billion in free cash flow. They can literally buy their whole company again in 3 years. Now, 5.5 years and 4 months, basically now. Crazy. You don't see this kind of undervaluation every day, and you don't see it with this type of growth. If PayPal had the opportunity to potentially be in the teens of growth or in the 20+% of growth, then yeah, PayPal would be sitting here ripping higher. You know what I mean? But they don't. PayPal's growth is going to be between 5 and like 8%. So that's why people aren't like, they're just beating it up. I still think it's undervalued, but all right. Let's see some questions. Did you have anything to add before we get into questions?
No, by the way, wow, I see the questions now. Okay, never mind.
Oh yeah. Do we talk about Zeta? No. Have you researched Zeta? Because I'm still doing some work on it.
Let's see it again.
And I don't have the updated numbers in here. I haven't done them yet. So I posted a little bit of like some SWOT analysis and some key points on Zeta from what I found so far, but nothing crazy. Why not cash secured puts? You could definitely do cash secured puts. You're not going to get that much premium on these cash secured puts right now. If you're selling cash secured puts, do it on a red day. If you're selling covered calls, do it on a green day. If you didn't already know that, now you do. You can definitely do cash secured puts. If we do dip down tomorrow on Oscar, I would definitely be selling some cash secured puts as well.
Yes.
I'll be looking at like a week or two out, see if I can get some great premium. If not, then I'll go like more a month out. And I usually go a month out, and I'll go around, depending how bad I want the shares at whatever price. But look, if I would buy this company at like, I'd buy some more at 17, 18, 19. So I'm okay with going with like a higher delta, meaning like the percentage of chance that you get assigned those. I'm okay with going with a higher delta on some cash secured puts, 2 weeks out, a month out, because I'm totally okay if I get slotted in at 17 and it falls to 15 and I'm buying at 17. It's whatever. $2 is not going to, destroy me in 5 to 10 years when I know this company's worth $59 today, or $30 on the EPS today, right? Can you click on Marvel? Marvel's not done yet either. All these ones in yellow are not done yet. I have a ton of other ones that are done up on the High Five snapshot. This whole library is, not to talk about my community or anything, but this whole library and all this snapshot stuff is part of my community. If you did want access to all of it, missed Oscars. Should I wait for a pullback? Do your due diligence. Rewatch this back if you missed some of this live stream. Understand what we're saying. Go watch the Emit live stream that we did a couple of days ago. Hear those guys and some of my points as well on there. And yeah, you just really got to make those decisions for yourself, not to be like, do your own research, but just take in what we're saying with a couple grains of salt. And then for the most part, just really look into it for yourself, because at the end of the day, here's the big thing. If we crack down lower tomorrow, right? And let's say Oscar goes down to $14. The sad truth is a lot of people are going to panic sell Oscar at $14.
Oh, yes.
And then they're going to be in me and Bull's comments saying, I hate you. And I've seen it already. I've seen it, I did Mobileye back, and we took Mobileye from like $11 up to like 20 some dollars, and we crushed it. But then they had a bad, things didn't work out, and they freaking fell like a rock. And we were still up, but then I get it, but this is where, look, I promise you will most likely sell and feel like a giant. You'll feel terrible, like you'll get that sickness in your stomach if you don't have that conviction. Even if you do have that conviction, you're still probably going to get that sickness in your stomach, but you won't sell. When I was in Tesla back in like 2016, 2017, even 2018, short attacks were crazy. Elon Musk is an idiot. Oh my gosh, Tesla's not going to ever, produce more than a couple thousand, EVs. EVs aren't the future. Gas companies, oil companies are going to kill this company. And look, great investment. Look where Tesla is now. It's a Mag 7 name. Okay. Like, you're going to go through fire with a lot of investments, and it builds your investing character, and it builds you up as a better investor overall, guys. It really does. So use it, do your research. Don't click the buy button until you've done your research. If you want to buy like a tracker share or something like that, just to keep an eye on it. But don't buy based off FOMO, because FOMO will only get you one thing. It'll get you buying high and selling low. So don't do that. Let's see. Yeah, I would wait for a pullback, Soraya. We might get a pullback tomorrow, and just figure out how much do I want to put into Oscar. Or sorry, do I want to buy Oscar? Will I have the conviction in it? If it goes down 50% tomorrow, will I buy more or will I sell? That'll get you to what you need to do. Do you plan to do weekly Oscar? That'd be cool. I don't know what Bull's doing. There's a lot of bullish people out there on Oscar, so
I wouldn't mind it if you want to.
I'd be down for that, and like throw in some new names as well.
Yeah. I'm gonna definitely check out that Zeta. I think that looks interesting. I just did a little quick run through.
The funny thing here is, though, what I've been seeing is that everybody, when this stuff happens and we get all this hype and we get all these like, smaller cap names running like crazy, that's when everybody wants to be like, where's the next Oscar? Where's the next HIMS?
Yes.
Like, you really want to be doing it, guys, when there's blood in the streets. That's when you want to be doing it. Like, in February and March, things were like meh. And we were doing our research into Oscar and like, whoa, this is undervalued. And then I got in because I was like, I'm not going to miss out on this. I'm just going to jump in this thing. And then obviously there was real blood in the streets. And just look from like April where things have gone. They've absolutely rocketed higher. and you could have been buying a lot of these companies, a lot of these great companies for dirt cheap. So yeah, I would say we're almost back to all-time highs. We got a lot of stuff going on. I build a portfolio, but definitely keep like 20 or at least 30% of cash around. I really would, guys. Like, I don't know. I don't know, but it's smart to keep it there because, yeah, we could blast through all time highs and go to like 6,800 or 7,000 or whatever. But yeah, we could also not. Why are they diluting shares? So Palantir is still diluting shareholders to this day. Hims is still diluting
Stock-based
shareholders to this
compensation,
day.
right?
Yeah, stock-based compensation.
I just saw that on Zeta too.
Yep.
190 million. That was one thing I was gonna text you on the side.
Yeah.
Yeah.
Guys, diluting shares, you should definitely, as an investor of any company, you should definitely understand it and you should definitely care about it 100%. Like all these companies, when they give their stock-based compensation and they bring more shares to, they offer more shares out to the public, your one share becomes half a share or 3/4 of a share. Realistically, you should definitely keep an eye on this and you should definitely focus on this. But I will say this, all these smaller companies, all of these growth beasts, they all do it. And I know that doesn't make it okay, but they all do it. I care more about, if I'm invested in Meta or Amazon or AVGO or whatever company, like a bigger company, you're established. It's like what's a good analogy? It's like better, like don't you dilute me, Meta, but Oscar and Hims and stuff, again, it's not okay, but you can understand, like they're small, they're trying to raise as much money as they possibly can, and they're trying to reward they're trying to reward their employees. Remember, stock-based compensation is literally them giving shares to their employees.
Yeah.
So, Tesla in the beginning, like people are millionaires from working at Tesla. They could have worked at like the sales dealership at Tesla and they're millionaires because they just got so much stock-based compensation. So we got to realize that too, guys. I'm not the biggest hater on stock-based compensation because here's how I see it. If you do good work, if you're a solid person and you're working hard and you're making this company better on the front lines or as a management role,
You deserve it.
You deserve it. You deserve it. You 100% deserve it. And it only makes the business stronger. It only makes the company stronger. So totally understand. Did you have anything to add on that?
No, I think that was pretty good.
Sweet.
I do have to hop off here in like a minute though. I have to go to a party at 3:30.
Yeah, all good, man.
Get going soon.
Yeah, just let me know. I might end this soon. It's getting close. Okay. But let's see, get through a couple more of these questions. I have 10,000 at 1623 average. Need to reduce my average. Look, 1623 is still really good. We're at 22 right now. So, I would always, look at the bright side. You're at 1623. Do you see it going back to 1623 anytime soon besides like a massive correction?
Listen, anything is possible. I have a buy zone at 1657. Do we get there? I have no idea. My major buy zone was around that 1430 where we've been sitting for the past 2 weeks before this run, 3 weeks actually before this run. It's possible. Listen, anything's possible. Did I think Hims was going to go from 70 back at 20? No, I did not. I bought more. But I definitely did not think it was gonna fully make that full inverse V, basically. And now it V'd all the way back up, basically. So yeah, no. I do have to hop off here though. So I will catch you guys later. Thank you, Ron. I appreciate it.
Man. Yeah, I appreciate it. Have a great party.
Yes, thank you.
Yeah. I'll get through some more of these questions, guys. Let's see. I got at 21, but I'm in for the long term. Great. And now you might get a chance to buy more, on a dip. And again, it's all just about conviction. You may get an upset stomach, if we go down to 14, 16, 17, 18. Okay. But what really matters is that you have the conviction and you see how undervalued this company is. You understand it and you understand the goal here. Every investment has risks, but this one's risk to reward to me is just phenomenal. Phenomenal, right? This isn't a company that's losing money. This isn't a company that doesn't have free cash flow. They have all those things, and every metric that you look at looks phenomenal. And yeah, every single one of them. So thinking of $14 CSP, hopefully get assigned. Yeah, that'd be great. I would just sell that cash secured put on a red day, my friend. So if we have a red day tomorrow, definitely try to buy that cash secured put then. So you think Oscar will be down to like $15 tomorrow? I don't think so, actually. Again, I don't know what the market's going to do, guys. I really don't. So it's just going to depend on what the market does, how Iran continues to respond. But yeah, I definitely think we're going to be red tomorrow. I mean, that should be an obvious thing. This market's been weird. If we were down 2% going into tomorrow and then we ended green to tomorrow, would I be surprised? No. This market's been absolutely crazy. How many times have we been down massively and then ran up, or been up 2% and then ran down? It's crazy. Tesla share owner since 2013, lost my hair. He said, I bet, man. I bet. But hey, congratulations. That's super awesome. You're crushing it. You're crushing it being a shareholder that long, and you definitely have some really nice gains. I can only imagine. Let's see. What do you think of some people all in Oscar? What's up, Thea? Community member there. That's such a tough question. If you're all in Oscar, I would take some trim. I would trim on a green day and look to diversify. Look, if you have a $10,000 portfolio, you shouldn't have 20 stocks. You should have like 3 to 5 or whatever, right? And have a good a good percentage wise, so in different sectors. So I like being heavy in tech sector, so like 50%, 60% tech sector, then like 30% in financials and stuff like that. Everybody's entitled to do what they want, but just me personally, I don't think being all in one stock is a good idea, because things can go wrong. And guess what? Even if Oscar continues to crush it, if we get a major bear market or crash in the market, Oscar most likely will come down with the rest of it, and it won't even matter that Oscar's doing great because the overall market's not doing great. Thoughts on OppFi? I think they're really good too. I think they're really good. Give me 2 seconds, guys. 2 seconds. I gotta go use the bathroom. It's been a long stream, so give me 2 seconds, and then I'll finish these questions out, and then we'll keep rolling for a little bit. All right. Oh, okay. So let's see. Thoughts on OppFi? Fundamental wise, OppFi. let's see. So OppFi, I would sit here and say, it's massively undervalued, just like Hims or just like Oscar. The big thing here is that I keep saying this too because I don't want people to think OppFi. It could be the next Oscar, but it's also there's much more risk to this name. And think of Oscar; they're disrupting the healthcare sector, the health insurance sector, and there's not a lot of companies out there trying to disrupt that health insurance sector. But OppFi, who isn't really, they're not really disrupting the financial tech, like fintech sector. They're more so trying to be a big player and try to take things away, you know, from others. And there's already so many other big players in the fintech sector. So that's my biggest thing. There's definitely way more risk with OppFi. But again, if you wanted to make a small position in OppFi, I mean, they are very, very undervalued. Their margins are crazy. They're rocking 56% or so free cash flow margin right now. So they're just pulling in massive, massive cash flow from the overall business and their revenue. So yeah, this thing looks crazy. It always looks so crazy to me. It's a crazy buy. This is a name that you could, throw some money into, not too much, high risk, high reward, and just see where it goes, honestly. So great question. I do like OppFi though. I really do. And I think they could definitely um get going. They already have been. They went from $7 in April low all the way back up to, $13-14 here. So basically double up. SBC is not that important for growth companies. Yes, I agree. I was interested in Zeta. Financials look good, but then I got to know about the lawsuit. What's your take on it? Would you still buy Zeta? Yeah, so I haven't. Again, I'm still looking into it. I don't really have anything to say about it yet. I know about the lawsuit, but I want to do some more due diligence into what the lawsuit's all about. What's their chances of winning? And even if they did lose, what are similar lawsuits and how much should they have to pay out? That's what I'm really going to be looking at. If you're long, isn't it about share count versus cost average? Yeah. I mean, how I always approach things is I want to decide, okay, I want to invest this much money into Oscar. I want to invest X amount of money into Oscar. How am I going to get that money into the company? Right? Am I going to dollar cost average? Am I going to do it based off margin of safety percentage, or am I going to go all in? Which I wouldn't do that. I would either dollar cost average or go based off margin of safety and then continuously get into the company where you feel best at, and then from there you get your initial position in there. And then if you want a dollar cost average monthly, if you want to get more exposure into the company as you start putting more money into your brokerage, then sure, you can do that. um Cost basis or cost average, yeah, cost basis is important. So it's important where you buy, but if you understand Oscar and how big of a undervaluation it is, I mean, yeah, you definitely want more shares. But again, it all just depends on how many shares you want. How much money do you want to put into them? What's your what's your layout of your portfolio? You know, like 15%, 20% going to health stocks. That's getting split for me personally, and like my public portfolio getting split between Hims, Oscars, the two big ones, and then Tempest. So what are the chances that they stop getting ACA money? Um, well, they just pulled the Medicaid, Medicare. Um, they just changed up the bill a little bit to where it's not going to affect ACA as much. So it really just depends on if that bill passes through, or they go back and say, okay, no, we're not making these changes, and we're going to keep Medicaid, Medicare. We're going to cut away from that, and basically the the I'm trying to be politically correct. Um, the lower income houses that are getting that insurance for free through Medicaid, Medicare, um, through the ACA how to like if they're gonna want to put that back in there and take that away from them, because that's really what it's doing. It's taking that away to where the government money is basically giving it to the lower income housing for free, and then that is giving the government is giving money basically to Oscar. So I can't put a chance or percentage on it, honestly. I don't know, but I do know that, it's similar to Hims GLP-1s. It's not going to affect the business as much as people think. And they have ICRA to continue to grow, and they still can grow inside ACA. It's just they're going to lose a small part of the lower income housing and basically the government paying for that. So tomorrow might be green. You're absolutely right. It might be, if people realize that, what does a war have to do with Oscar being a great health insurance company in the United States and continuing to make the same amount of money because it doesn't matter? Yeah, it might be green. But typically how things work is when markets are red, everything goes red, especially when it's war. Um, I have no problem with all in one stock and portfolios small. Yeah, like I said, everybody has their own way of doing things. I definitely had a very, very large position in Tesla. I had other positions as well. But yeah, I mean, if you have a smaller portfolio, say, a couple thousand, and you're sitting there and you don't really want, you know, 3 or 5 stocks, you just want to focus on just one stock, then yeah, that'd be great. Anyone own Lemonade Investor since 2020? I'm not invested in them right now. Please share your thoughts with us once you complete your research on Zeta. Most definitely will, Sreya. Most definitely will. Just gotta find the time to keep doing that due diligence. Honestly, busy last week or so, and then obviously I got to spend time with my kids. Like 100% got to do that. Um, Nothing's more important than them. So, all right, that's all the questions. I don't see any other questions. Think we answered them all. Yeah, guys. Here we go. Any good undervalued stocks right now with high growth potential? I would say Oscar, OpFi is one that I like. Um, let's see who else we got. I like Zscaler. I'm waiting for a pullback on them though. That's really good, Lee, that you only have 7 stocks. You don't want too many stocks. One, it's really hard to keep track and listen to all the conference calls and keep up with all the stocks, but also, yeah, having too many is just not a good idea. Quick opinion on Marvel. I haven't even touched that one on DD yet. I thought I was going to get to it this weekend, but I haven't been able to. So I don't know. I can give you guys technical analysis. I just did a bunch of technical analysis in my recent weekly preview video. If you haven't checked that out, I did technical analysis on Zeta, Marvel, IREN, IREN, and SoFi and Hood and a bunch of other stocks. So if you want to check that out, it's on my YouTube. Bob is undervalued too. It's a Chinese name though, so there's that risk. Amazon's still pretty undervalued. I like Amazon where they are right now. You're not getting it as big of a deal as you once did, but still a great deal in my opinion. PayPal's undervalued, but it's not a high growth name. Hims is still undervalued, and it's a high growth name. Tempest, in my mind, is undervalued, and it's a high growth name. So yeah, there's definitely a lot of names out there, Sreya, that could be super solid. Does a 718 call leave me enough time for a pullback and another rise with Oscar? Are you talking about a covered call? I'm guessing you're talking about a covered call, Cameron. For a 16-hour call, that's gonna be tough. If it's a covered call, that's gonna be tough to get back there, even with a big pullback tomorrow. Yeah, I wouldn't. You guys want to know like some option stuff real quick? I would not buy any calls if you have an implied volatility over 100%. Typically, I don't buy options with an implied volatility over like 50 or 60%. Sometimes I'll make an exception if it's really good opportunity. But guys, if you get a stock with over 100% implied volatility, it's going to be very, very difficult for you to make money on those calls or options in general. Because basically what it is it's saying the volatility is so crazy that if the volatility drops, your stock or your options are they're gonna, even if it goes up, you're not gonna make as much as you would if the volatility wasn't as crazy. That volatility really messes up your options, guys. It really does. So it's really important to not chase and be in these options that are 100% plus implied volatility, because that's really going to hurt you. It's going to hurt you bad. And if the stock goes down because of that high implied volatility or IV, you're gonna lose a lot of your options price and the amount of money you have in it very quickly. Like for example, if you bought an implied volatility of 50% on an option on a call and it went down $1, well, then you might lose out of 100% position, out of 100% of your money, you might get down and lose, 20 or, 20, 15, 20%. If the implied volatility is like 100% plus, then you're going to lose more like 50% on your options. It's just how it works with the implied volatility, because essentially whenever you get a lot of people buying and selling, people can charge more for the premiums that they're selling the options for. So they're selling for a higher premium. And then once that volatility goes away, then people start charging less because they're trying to sell them. And then basically you're stuck in this gap of this, like them overpricing things, kind of like the PS5. Like I bought a PS5 here from the store and I'm selling it for up here, and you're buying it up here, right? From the person upcharging for it. But then you're gonna then they become, they start making more PS5s, and now down here the price comes back, so you just lost all this middle ground on your money. I hope that makes sense. Sold hymns August, $100 calls last month. Premiums are crazy. That's awesome. You probably made amazing premiums on that. That's really good. Hymns could go to 100 by August, but most likely hymns would probably dip tomorrow with everything going on, and maybe this week further dip. So you definitely should be able to get some good money on those premiums and lock in some of that money. I usually like selling my covered calls and covered cash secured puts. I don't get greedy. I don't try to wait till the expiration. I don't try to go 100%. I'm usually fine with like between 70 and 80% on my covered calls or cash secured puts is what I typically am good with. Roll those $100 calls, the $90 calls last week. Nice. That's awesome. But all right, guys. Yeah, I think we answered all the questions. I think this is a great live stream with Bull Knots. I think we covered a lot. I feel a lot better about the bull case and and thesis that I have, and the risks and the weaknesses and the SWOT analysis. I feel a lot better about the product I put out on OSCR this time around. Less nerves, being my own live stream and everything, and being able to talk to you guys all, and having Bull here, and me and him already have done spaces in the past. So yeah, I feel like it's been a lot better product to you guys, and giving you like my real thesis on OSCR and what I truly believe, with having more time and more of the stage to put that out there for you guys. So yeah, I really appreciate you guys joining in. Can't believe that we got, at one point over 2,000 people in here. That's super awesome. It's the biggest live stream that I've ever hosted. So congratulations, everybody, for being here. You're in the world record books in my mind. I love you all. Thank you for being here. Definitely want to keep doing more live streams like this. Somebody brought up a weekly OSCR live stream. That'd be super awesome, and I'd be so down for that. Bringing on different guests, me and Bull. It's super awesome, and I would love to continue doing this and trying to find new amazing retail names that we can all get behind and make a lot of money on, right? Whether it's side money for you or whether it's this is your whole gig, right? But I appreciate you guys all. Do me a favor, smash that like button, hit a comment down below. What was your favorite part of the video? What's your bull thesis? What's your cost basis on Oscar? What's the next retail name? Drop some comments below, guys. I'd love to reply to all of them. And yeah, I'll catch you guys in the next one. Have a great Sunday. I'll see you tomorrow. Hopefully it's not too red. Let's get out there and buy the dip and get some great companies under our belts. See you guys.